I just want to talk about something that that has come up in the panel, which is, I can be, corrected because I'm not a tax expert, but I do want to talk about something called the Delaware Loophole. And there's many Delaware loopholes, but I'm going to talk about this particular Delaware loophole, which is when a corporation registers in Delaware, but what a corporation will do is they will put a lot of their things called intangible assets in a subsidiary that's registered in Delaware. An intangible asset is a thing like a trademark, leases, things that are not sort of physical, but for which they derive profits. The profits in Delaware are not taxed, so the corporation can be doing business elsewhere, but the assets are registered in Delaware, they're not taxed. But what makes it even nicer from the corporate standpoint is not only are they not taxed in Delaware, so it escapes taxation, but also those same assets can be used to create a tax deduction in the state in which the company is doing business. And then the other part that's also so sweet from a corporation standpoint is if you have a corporation that's registered in the Caymans or in another area, at some point, you're going to have to repatriate those earnings back to the United States and pay taxes on it. But if you sort of have these intangible assets in a Delaware corporation, it's between the states. It's one state sort of allowing a corporation to reduce their taxes in another state. There's no repatriation. Once you get that tax break, it's permanent. And so the issue of the Marcellus Shale companies came up. And one of the things is that with all these new Marcellus Shale companies coming up in Pennsylvania, you have about 400 of their subsidiaries are located in Delaware, so that the intangible assets of those companies will not be taxed and can be used to reduce their tax bill in Pennsylvania. Now, there's been an academic study that shows that within the last decade, about $9.5 billion was saved by corporations or lost in terms of tax revenues, however you want to look at it, through the Delaware loophole. And in Pennsylvania, there was a group there that estimated that the state had lost about $400 million of tax revenues because of this, and that was before the Marcellus Shale companies come in. And as one last note on this point is the one that I love, which is the sort of the poster child for the Delaware loophole, is WorldCom. If you remember, WorldCom sort of went down in flames, spectacular bankruptcy. Well, WorldCom had saved billions of dollars on its interest on its taxes in other states because of the Delaware loophole. And their intangible asset was something called management foresight. So the intangible asset was the brilliance of this corporation. Well, it was the brilliance of this corporation that, of course, caused it to crash and burn, and yet that so-called brilliance was, and saved them billions of dollars. So, Rebecca, you might have some more refined comments on my sort of mangled description of the Delaware loophole.
I think you did pretty well. The Delaware loophole is actually what S.C. Johnson was using. So the 50 states, most of them impose some kind of corporate income tax. There's a few that don't impose any corporate income tax, like Nevada doesn't, for example. Delaware does have a corporate income tax, but it has some very loose rules compared to a lot of the other states. So some of the states are fighting back with different ways that they're reforming their own tax codes. But Delaware has a corporate income tax, but it exempts from that tax companies that only hold intangible assets. So if your assets are loans, patents, leases, royalty generating assets like a trademark or something like that, then you're exempt from corporate income tax in Delaware. So companies are putting subsidiaries in Delaware to hold those assets, and meanwhile they're generating deductions back in the state where they're located and doing business, and maybe all the other states, maybe they do business in all those states, and they're generating a deduction for paying those royalties to the Delaware subsidiary. Then the Delaware subsidiary, ends up with all this cash, and they loan it back out to the parent company and to other subsidiaries, which generates interest deductions for the parent company and the other subsidiaries operating in other states. So it just sort of perpetuates itself. It's a huge problem, and it only affects what these companies are paying in state-level income taxes. In order to avoid the federal-level income taxes, they need offshore subsidiaries, which they also have plenty of.
I'd like to add something here. Many of you have read about what HSBC has been involved in and the problems of HSBC, but if you start poking around in that, you begin to realize that there are two different realities in a corporation of any size. Reality number one is how it does business. If you were to talk to somebody who worked for HSBC, they'd say, I work for HSBC. And it wouldn't matter where in the world they were. And their line of reporting would be through divisions, regions, up to a central headquarters. They have really no awareness of the number of subsidiaries, the corporate structure. The corporate structure only comes rolling out when one of two things happens. A regulator shows up and says, maybe three things. A regulator shows up and says, what are you doing here? Well, you can't look at that because your regulatory framework is limited to looking at the bank, and we have a brokerage firm. Never mind that both operate seamlessly, and if you're a customer, they'll take care of everything. But when the regulator shows up, it's two different businesses. Get your butt out of here. So that's one problem. The second problem is liability. When somebody shows up and they want money back, or they want to go after the corporation because they've done something wrong, well, you see, you're suing subsidiary X, and that's got nothing to do with what the other subsidiaries were providing services, and that's a separate business, and you have no jurisdiction, and blah, 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 and there's no way to get your arms around it. And then finally, there's the question of tax, where once again, if you come along and you're a tax collector, you run into this huge maze, even though it's a single entity and it behaves like a single entity. Now, to the point of the agriculture and the lack of capital to really do what has to be done in agriculture, it's no surprise that the major companies involved in grain trading are all companies that are totally opaque, privately held, hundreds of subsidiaries. To the extent you can actually find one that's listed, you get hundreds of subsidiaries, and they're all set up in a way that makes understanding what's going on in them or tracking the trades a virtual impossibility. So this business of the anonymous corporation that is now rolled into some large entity is an enormous problem, and the SEC has walked away from it. The SEC has allowed corporations to say that the effect of the subsidiary is not material, and then simply not report what's going on or what happened there or how they're using it. So we have this kind of black hole system for cops, regulators, tax collectors, whereas when the company does business, you're dealing with the company, the management, and the control is absolute.